Hey guys, Max here, and yesterday was actually a little bit crazy. We had a halt to the market rally, stocks fell for the most part. We saw yet again another rise in the price of oil, some pretty interesting news out of Russia regarding their attempts to survive the sanctions, and we're also finally going to see the Russian stock market open back up again, but with some ridiculous rules that basically make it a giant fraud. So let's just get right into it. So what happened in the markets? Well, by and large, as I said, stocks fell. A few days ago, I showed this stock market map, and a few of you liked it. You asked where to find it and such. I will link that site down below in the comments. And it shows how certain companies and sectors and actually the market as a whole performed. So it's quite good for market recap. So let me know if you want to see more of this in the future, if it's useful or not in the comments down below. Now, as you can see though, most sectors performed poorly, but not awfully. Energy and commodities did quite well. The S&P 500 was down 1.2% for the day, and the Nasdaq was down 1.3%. So we saw an end to the rally of American stocks, or at least a halt in that rally for the time being. Maybe it'll continue, let's be honest, no one really knows. Now, the MSCI World Index fell 0.7%. Most stocks in general fell, as opinion has just slightly changed. There was no real single trigger for this change in sentiment. There were some minor concerns about new curbs against Russia, new sanctions implemented by the West, and then Russia's attempts to get around those sanctions, but that was always on the table and quite obvious in my opinion, and so I think the markets actually likely priced that in. Now, oil prices, as mentioned earlier, rose too, which is worrying, along with a bunch of other commodities. Again though, that's all expected. We're in economic war with a major exporter of those materials, so why on earth would anyone expect those prices to fall? Now, WTI crude oil rose 4.7% for the day, and it now sits at $114 a barrel. Brent crude oil is up as well, and it now sits at $118 a barrel. Are we surprised? No, of course not. Natural gas prices rose too in Europe, 5% yesterday, 18% from last week, on this news regarding Russia requiring unfriendly countries to pay for gas in ruble to prop up their currency. We'll talk more about that in a bit, but it's basically just thrown around some concerns about how much gas there will actually be in Europe, so prices rose. Now, bonds had a reversal to their price declines as well. They saw some inflows on fears that erupted basically out of nowhere, as I said. Yields fell across the board. The US 10-year Treasury yield fell 9 basis points, the German fell 4, and the British fell 8. Now, the US 10-year yield still sits at 2.3%, far higher than it's been for pretty much the entirety of the last 3 years. Currencies saw no major changes except for the Russian ruble, which rose 5% on that news earlier mentioned, as that might force EU countries to buy up the ruble. Gold sees a little bit more action as an inflation hedge, or just a hedge to uncertainty in general, and it rose 1.3% after falling for the week prior. It's now sitting at about $1,950 an ounce once more. Finally, in crypto, what happened? Well, there weren't any huge gains, but there were some. Bitcoin is sitting at about $43,000 and Ethereum at $3,000, so up a couple of percent each, but nothing major. The altcoin market actually did pretty damn well. Some, like Cardano, are up as much as 15%. Dogecoin was up 14% as well. ApeCoin, I wish I didn't even have to mention that stupid name, but it's up 14% now. Now, I'm not really too sure why we've seen this little pump in the altcoin market. There are some people claiming that the increase in a bunch of coins that really hadn't done much over the last few years, like ETC, is due to the coming Ethereum difficulty upgrade as miners prepare to move to different coins. That's a big maybe though. It's just an idea I've seen floating around, and I haven't seen any evidence to actually support that, so take that idea with a grain of salt. So that's what actually happened in the markets. What's actually driving all of this though? Well, the huge bond outflows over the last week or so now amounts to the worst ever crash in global fixed income assets, literally ever in history. $2.6 trillion of value has been lost, so not a small amount at all. Now, why are bond prices falling so quickly and yields rising? Well, in short, there are big concerns about the ability of companies and governments as well to survive during times of expensive financing, which means it's less desirable to hold on to this debt. Pretty simply, if you doubt the US's ability to pay their bonds, you would be less inclined to own those bonds, so prices decrease. And that's what we're seeing happen, but on a global scale, and not just with government bonds like the Treasury or British or German or whatever, but corporation bonds as well. This is mostly spurred on by huge inflation that we've already seen and the fact that it's only getting worse. Now, this is the kind of thing we mean when we say that inflation is bad for the economy as a whole. It isn't just bad for individuals who have to spend more on their gas or their food, but almost everyone and everything. Commodity prices, for example, are up 26% over the last year, while consumer prices are up around 10% when using real data. Companies which need those commodities are going to suffer, and higher borrowing costs from raising interest rates and rising bond yields as fixed income is less desirable means the risk of these companies going under, running out of cash, or just being unprofitable increases as well. Once again, as discussed yesterday, this seems to be what's driving equity markets to broadly rise over the last week. We weren't exactly sure what it was at first, but the narrative right now is that stocks are being seen as an inflation hedge, sort of similar to the there is no alternative we saw over recent years as well. The problem is, though, most of these stocks and their prices might act like inflation hedges in the short term right now, but in the long term, the companies that these stocks are representing will not be inflation hedges, and they will mostly see earnings fall as a result of this. This is, of course, a very strange market. This is what happens when you break everything by printing trillions of dollars for 2 years when it isn't necessary at all. Things stop working as they should. Now, for the rest of the day, we're going to be talking mostly about Russia, because there are two major developments here. The first is that Russia has demanded all unfriendly countries buy natural gas with the ruble, not the euro or the dollar or anything else. Now, who are these unfriendly countries? Well, these countries, funnily enough, almost perfectly align with countries that score highest on the democracy index, so surprise, surprise. Anyway, the idea here for Russia is that these countries will have to buy the ruble to then buy the gas, which will provide buying pressure to the currency and force the price up. As a result, this should help curb the crazy high inflation Russia's seen over the last month, stop their wealth collapsing, and maybe even save the economy. That's the idea, at least. Will it actually work? Maybe. It's hard to say right now. Right away on this news, the ruble did rise about 5%, but that wasn't actually from countries buying the ruble to buy their natural gas. It was simply from speculators guessing that that will happen and trying to profit off of that process. So why might it not work? Well, countries may just refuse to do what Russia wants them to. They could firstly just not buy any gas at all. It's more feasible for some countries than for others, and as we get closer to summer, it is basically spring here in Europe, and some good weather comes in, it's possible that European countries just bite the bullet and accept higher gas prices. They refuse this obligation from Russia altogether, and also accept that it's going to cost them money. There's also a possibility that European countries just refuse to pay in rubles. It's a breach of contract, as Germany came out and said. They have no legal obligation to do as Russia says, of course, and European countries aren't the only ones that would suffer from this. At current prices, Russia is making about $1 billion a day selling gas to Europe, and with the state of their economy, they need that money too, especially if they want to continue the war in Ukraine, which is going to keep going on for, let's be honest, probably months. Now, Italy said a similar thing to Germany. They don't want to pay for gas in rubles. Basically, this could work for Russia. It could not work. We really don't know right now. It will depend on how both sides act, who's willing to pull out first, that sort of thing. The next big news about Russia, though, is that their stock market is opening for the first time in a month since the invasion started, but there are loads of limitations, so it's basically all a fraud. It's not a real exchange. Now, what are those limitations? Well, the first is that there are only 4 hours of trading across the day, so there are literally less hours for markets to sell off. Only 33 of the 50 listed companies are allowed to trade at all. Those 33 are, of course, the ones least impacted by sanctions, so as to stop the index from falling too much. Short selling is 100% banned from the markets altogether, again, to try and ensure the markets don't collapse. Russian investors are not allowed to sell any stocks until April the 1st, and when we get to that date, let's be honest, it will probably be extended. Foreign investors and institutions are not allowed to sell any stocks ever. Literally ever. The only people in the world allowed to sell Russian stocks right now are Russian companies. Now, obviously, these companies don't want their share prices to tank either, so they're being cautious with any sales, and every other person, institution, or company in the world is only allowed to buy Russian stocks. On top of that, the Russian Wealth Fund has jumped into the markets as well and started buying up $10 billion worth of stocks at random too, again to try and raise prices. Now, prices are of course determined by buying pressure versus selling pressure, bids and asks, and Russia has basically banned any selling pressure, so stock prices have increased, which is kind of hilarious to be honest. This is without a doubt a fraudulent market. There's nothing else to say here. It isn't real, and these prices aren't real either. If I hold a gun to your head and tell you to buy my pen for $1 million, that doesn't mean that the value of that pen is $1 million. It means I'm a psychopath and you want to live. If you want to see how Russian stocks are valued in a real free market, then look at Russian shares listed on foreign exchanges like Sberbank on the London Stock Exchange. The share price used to be around 21 pence, it's now less than 1 pence, or a 99% collapse in its value. To anyone thinking about buying into Russian markets because the prices are going up when you Google the stock, remember that it is illegal for you to take dividends from these companies, and it's illegal for you to sell the stock once you've bought it. If you put $1,000 into a Russian company, you will never receive a dividend from them, no matter what the claimed yield is, because sanctions prohibit that dividend from reaching you. You will also never be able to exit your position and get your money back on the Russian markets because, again, it's illegal for foreigners to sell stocks on the Russian market. So if you do somehow manage to sell it on maybe a different exchange like the London Stock Exchange, which again is nearly impossible itself because sanctions prohibit anyone on the other side from buying those companies, you'll be buying Sberbank, for example, at about $1 a share, but you'd only be able to sell it for less than 1 cent per share. And that's if you can even find a broker to help you transact, which is pretty unlikely in the first place. In short, if you've had this idea, if you've thought about buying up into the Russian dip, don't bother. It's the stupidest idea you've ever had. Now, if you enjoyed this video, then make sure to like and comment and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world-famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.